I think it's that tweet. I think it's the fact that we've now gone through 2 days and on to a third day. I think the news that's coming out that, in China, the president came out last night in China and said that they're making real progress. I think all that stuff is pointing to, a better outcome. And I think the market was dying for positive news. I think it's clear in the last couple of days you've seen the reaction in the market. It's almost kind of like they've released a pressure valve a little bit. And as long as it continues down that path, I think the market moves higher, right? The minute you start to get angst again, or the minute you start to get someone, with the hair up on the back of their neck, then I think the market starts to get nervous again. But right now it feels okay and it feels good.
Charlie, are you telling investors to get back in?
That's it, me. We thought that the market got oversold last quarter. We think you shouldn't get in and out of markets ever. It's dangerous to come in and out and try and time markets, but it's clear that the market is a lot cheaper today than it was a quarter ago. I just want to say, I've heard so many times today about how the Chinese economy is slowing. The Chinese economy is not slowing. People are confusing a second derivative with a first derivative. The Chinese economy is growing faster than the U.S. economy has grown any time over the last 10 years, more than 5% per year. The Chinese economy is going to consume more copper this year than it did last year. It's going to consume more oil than it did this year. It's going to eat more hamburgers. The Chinese economy is growing. It's going to continue to grow. And so we have to be careful not to be confused in our analytics about the difference between a second and a first derivative.
Maybe not buy more top-end iPhones, though. We'll have to wait and see for those numbers. Rick, talk us through your take on today's action in your world, and particularly that very disappointing data out of Europe.
Yeah, no, Europe continues to be disappointing. Some of their metrics for the service sector, manufacturing confidence. But like the U.S., it's not falling quickly, but they've gone from basically slightly above average a year ago to basically a little below average. And we've gone from an A to a B in much of our data. Case in point today would be job opening labor turnover. It took us a long time just to get over 6 million in jolts. We've had 7 million handles. So to backtrack to 6.88 million wasn't a disaster. And, Charles talking about China, the problem with China isn't so much we could argue their growth or how much less of it they have now. I understand his derivative argument, but it really goes to the point. Why are some of Chinese industries, and why is there some demand in commodities versus last year a bit higher? Because of the stimulus effect. The problem around the globe is we still need to continue to prime the engines. We're in the U.S. It's starting to run better on its own, and that's key.